Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to the effective interest rate calculation on a discounted loan. Therefore, we will discuss what a discounted loan is and then how to calculate the effective interest rate on it and why we would want to do so. Get ready, it's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. Notice that we do have two tabs down below. If you are working with our Excel problem or Excel sheet, then you might have four tabs, two with the answer to them, two with our practice problems. If we go on to our second tab here, we'll have a similar problem, but it will be a bit different here and a little bit more complex. So make sure you go to that second problem as well after we complete the first one. Back to the first problem. We're going to have our information up top. We'll be taking a look at the effective interest rate on a discounted loan. So the first thing is, well, what is a discounted loan? So we'll have a little bit discussion of a discounted loan. It's a little bit different than our normal kind of scenario, but it's not too complex. It's easy to make sense of. However, when we think about the interest rate, it'll be a little bit more complex. So for example, we have the bank could loan the company cash for 1 year of $8,000, interest rate 15%. So what is the effective rate of the interest if the loan is discounted? So what if the loan is discounted? So normally, let's think about before we have the loan being discounted. Let's assume we're going to be borrowing $8,000 at 15%, and we're simply going to be paying back both the $8,000 and the 15% at the end of the year. Well, then the calculation of the interest would be quite clear. We're just going to use our interest calculation down here, which is the principal times the rate times the time, which is straightforward this time because we have the principal of $8,000 times the rate, which is going to be that 15%, and times the time is just one because we're going to have it for 1 year, which would be if we took days, 360, approximating 360 days in a year divided by 360, which of course would simply be 1, and that's going to give us the interest. So we're simply just taking the 8,000 times the 15% of the 1,200 at the end of the loan. If we were paying interest and principal at the end of the year, we would then owe back the $8,000 plus the interest or the purchasing power of having the rent on the loan, basically, of the 1,200. Now, what does it mean for them to discount it? Well, if they discount it, they're going to say, all right, now we're going to take the interest up front. So they could say, well, we have an interest rate, but it's not really and they could say, well, look, the interest is $1,200, and we're simply going to take that out up front, meaning we're going to give you right now, not $8,000, even though the loan we're going to say it's for $8,000, we're going to give you the $6,800. We're going to give you $6,800 instead of $8,000, and you're going to pay us the $8,000 at the end of the year, in this case, a 1-year loan. So now you're saying, well, okay, well, we still paid $1,200, but instead of getting the $8,000 up front, which we get to use for the entire year, and then paying back the $8,000 plus the rent on that money, which is $1,200, we're not getting $8,000 up front. They're taking out the $1,200 up front. They discounted it. So the loan amount is $8,000. They discounted it down to $6,800. But when we pay it back at the end of the year, we have to pay back the entire $8,000. So we'll pay back the $8,000 at the end of the year. So you can see they kind of flip the percentage that we're taking here. Now, when you think about that, you're saying, okay, well, we're still paying the $1,200, but we don't get to use $8,000 for the entire year here. So that's substantially different. And we're not paying back at the end of the year. We're not paying back $1,200 over the $8,000 we got to use for the entire year. We're paying the $8,000 total, which includes $1,200 over the amount we got to borrow, which is different. So if I was to compare or think about, well, how can I think about that in terms of just normal kind of standard interest rate, a standard annual interest rate, the effective rate, so that I can kind of standardize what you're talking about? Because this 15% isn't really the interest rate that we can do comparisons in terms of a normal loan standard, because you're taking the money out before I get to use the money. So it's not really 15% with regards to what we normally think of as a loan. So let's think about what this would look like. If we go into our interest calculation, we have down here the effective interest rate is going to be equal to the interest divided by the principal minus the interest. And this is why this calculation is a little bit more easy to use, because now we can kind of define this principal minus the interest, what that means. times basically the inverse of the time fraction, which is the days in a year, 360 in our case, because we're going to round the days to 30-day months, divided by the days in the loan outstanding. Now we can basically derive that from our simple interest formula, like our simple interest formula. Interest equals the loan or the principal times the rate times t, and t is a fraction, the fraction of basically, the days compared to the total days in the year, or the fraction of the year that the loan is going to be in our terms here, because we're dealing with a loan under a year, less than a year loan. So now if we were to solve for r, looking for r now, we would say, okay, if I do the algebra there and I say, now let's solve for r would equal interest divided by p times t. Now there's going to be the one twist to this, however, is that the principal that we're talking about isn't the principal that they're stating here at the $8,000 because they discounted it. So we've got to figure it's going to be the principal minus kind of like the interest that they calculated on, which is the $1,200. So that's kind of like the little quirk here, which you can see if you were to rework this. If I was to rework this, I'd basically take t here, which is a fraction, and instead of putting it in the numerator, we take the inverse, and we can multiply it times that fraction, right? Which was the inverse of the normal t fraction. So that would be interest divided by the principal minus the interest, which is basically p here, except now it's been modified for the fact that the principal is going to have this discounted effect, times the days per the year, 360, over the days in the year, basically time the inverse of the time fraction. All right, we'll do that this way, and then we'll calculate the same thing using basically this formula. We're going to be converting first this formula into basically our worksheets, just doing the algebra vertically. This is very useful if you're working in a situation where you want to do different basically example problems, so you can recalculate this information. And it's also useful just to practice worksheets in Excel and just breaking out the algebra in this format. You could, of course, plug these numbers into the formula algebraically as well and work it in an algebraic formula. What we want to do is take this half of the calculation and end up with the outer result in the outer column and do any sub-calculations inside. Same with this half. So we'll start off with this half of the calculation. That's going to be interest. So interest. So we're going to say that the interest calculation is going to be the 15 times the 8,000 times the 15%, which we calculated here to be 1,200. So that's 8,000 times the 15%. That's the interest, but the rate that we use to calculate the interest isn't really the effective rate, right? That's going to be the rate on the that's like the discounting rate. So then we're going to take that and divide it by what would normally be P, the principal, but now the principal is really going to be the 8,000 minus the 1,200, because that's the money we actually got. So the principal is now principal minus the interest. So that's going to be equal to the 8,000 minus the interest, because we only got 6,800. So the loan that we actually received wasn't $8,000, even though that's what, they kind of say it's a discounted $8,000 loan. The money we got, which would be in a standard loan terms, what we actually received, $6,800. I'm going to underline that. Subtotal then, subtotal. I'm going to pull this to the outside. That's going to be the first half of our calculation. It's going to be equal to the 1,200 divided by the 6,800. Let's add some decimals so we get a feel what this number is. It'll typically be fairly small. Home tab numbers, we're going to add a few decimals here. So there we have it. And then I'm going to indent here, home tab, alignment, increase the indenting. Now we'll do the other half, which is the inverse of time, the inverse of the time ratio, which is the days in a year divided by the days the loan is outstanding, which is 1 here because it's for the entire year. So the days in a year, we're gonna assume nice even 30-day months, which will be 12 times 30 or 360, and then the days of loan outstanding is going to be the same because it's one annual year, which is going to be once again 360. And so I did something funny there. Hold on, 360. So I'm going to underline that. Let's put an underline here. And that's going to give us another subtotal, which I'll just divide that out. This equals 360 divided by 360 or 1. So I'm going to say 1 there. And I'm going to underline home tab, font group, and underline. And that's going to give us the effective rate. So the effective rate then is going to be equal to this number times 1. which is simply going to be that number. I'm going to percentify this now. Home tab, numbers, percentify. We'll break this out. Now, this is a little bit easier of a calculation given the second half is just 1 because it happens to be for 1 year. We'll do a little bit more complex calculation next time. Just note this is the major difference we have here and the principal. I'm going to make that yellow to emphasize that. So that's the major difference. We kind of have to figure out what that principal is going to be, which is basically principal minus the interest on the discounted loan. Now we can kind of double check that using this formula again. We'll say, well, what would the interest be if I was to calculate this? The kind of the cost of us taking this loan out. We'd say, all right, let's just do this calculation. That's going to be principal times rate times time. This would equal the principal, which is now this 6,800 times the rate that we just calculated here times time, which is just 1, 360 over 360. So it's just 1. And that means we're going to have interest of 1,200. So you can see if we think of this as a normal loan, we took out 6,800. We had to pay total interest of 1,200. Therefore, the rate's got to be the 17.65 about. So I'm going to go, all right, let's do that. And let's do this calculation one more time. And let's do it using this formula. So I'm going to break out this formula. This is just an alteration of the same formula. But you will also often see it in this format, and this is a nice, easy way to see it, except for now we've got to realize that the principal needs to be thought of as the money we're actually getting, not what we would call the principal kind of the discounted loan. And time is really a fraction, so we got to make sure we understand that that is a fraction, and then we can calculate this. I'm going to do the same kind of thing and do this in a table. You could do it algebraically. Here I'm going to do it in the table, basically breaking out the algebra into a table. Very useful skill to have, very useful to make a worksheet that you can then use different data input points to adjust easily. So I'm going to take the interest on top, interest. I'm going to put that all the way to the right. That's going to be our numerator. So I'm just going to put it all the way to the right. And that's going to be then the 1,200 we calculated. Then I'm going to do the calculation in the inside of the denominator. And I'm going to have 2 columns because time is going to be another sub-calculation given the fact that it is actually a ratio. So I'm going to have these two on in this middle column, P and T. So now we have the principal. I'm just going to say this equals the principal minus the interest, which is P. This is kind of the new thing. I'll make this yellow again. This is kind of the difference, or the thing we got to be aware of here. This is going to be equal to the 8,000 minus the 1,200. So we're only getting 6,800. And then we've got the percent of a year, and that's going to be, now we're saying T. Now T, I'm going to do another sub-calculation, which will be nice and easy. This is going to be the days of the loan. It's a year, 1 year exactly of the loan, so I'm going to say 12 times 30. Instead of 365, we're using 360, rounding the months to 30 days. Days in a year also being, of course, 12 times 30, because we've had this for 1 year, so 360 over 360. Home tab, font group, underline. Notice this is the inverse of what we did here, because this is the inverse of time here. And so then if I calculate that out, that's going to give us the percent of a year, which I'll bring over to the outside, which is simply going to be 360 over 360. And that's going to be 1. I'm going to underline this, home tab, font group, and underline. Now, of course, we have P times T. Let's do some formatting. Selecting these 3, home tab, alignment, indent. I'll format this one, home tab, alignment, indent. And so now we're going to say, all right, now let's have a subtotal that I'm going to be on the outside, having the denominator, P times T, which is going to be this column. This is going to be equal to the 6,800 times 1, which of course is simply 6,800. Home tab, font group, and underline. That's going to give us the effective rate on the discounted loan. The effective rate on the discount loan being just dividing this out now. This equals the 1,200 divided by the 6,800. Let's percentify this. Home tab, numbers, percentifying it. Adding a few decimals, we get back to that 17.65. If I want to double check this then, I could say, well, let's just plug that into our normal interest calculation formula and see if we get to what we would think we would, which is that 1,200. So we're going to say, all right, this equals principal, which now once again is really 6,800, not the 8,000. That's our key point. And let's pick it up from here. This number times the rate, which is now 17.65, and the fraction of a year, which is going to be times just 360 over 360, because this is for 1 year exactly. That gives us our 1,200, verifying basically our calculation. So if I go back up top, Home tab, Font Group, I'm going to make this blue, and I'm going to put a little box around it, as is our standard format. All right, now let's go to a little bit more complex, where we're going to have not just 1 year, and so we'll have to deal with this kind of fraction of a year in a little bit more complexity. That'll be in, of course, Practice tab 2. So here we have our information. We're going to say we borrowed 15,500, 90 days, and the interest is going to be 290. And then we're going to say that this was what is the effective rate if interest if the loan is discounted. So then we'll go into the discounting. First, let's consider what if it was not discounted. What would this mean? If we had 15,500, we're going to borrow it for 90 days. Then we're going to be paying the 15,500 back at the end of 90 days, plus the rent on that money, which is going to be the interest of 290. We could first think about that scenario, and then thinking about what would be the rate of interest given that scenario. We could figure that out using basically this formula down here, or pretty much a variant of this formula here, which are basically the same thing. And then let's think about, well, what if we discounted this, and then what would the effective rate be? So let's first figure the normal rate. I'll do that to the right, actually. And so I'm going to say, all right, normal calculation on the rate. We'll do a kind of a variant of this, actually we'll use basically this calculation for the rate. So let's say we had the interest. So I'm going to say if the interest, I'm going to put that in the outer column all the way to the right. The interest is going to be the 290. So that's going to be our numerator. And then we'll pick up the principal. Now, I'm going to assume under normal circumstances that we got actually 15,500. If it was a normal loan, we would get 15,500. This is where the change will be. I'll make that yellow. That's where the difference is going to be. And then if we took the percent of a year, and actually this number should be in the middle column. Let's bring it over here. And that's going to be yellow. I'll make that yellow. And then if I took the percent of a year, which is now not exactly 1 year, so this is going to be a little bit different. We're going to say the days of the loan. The days of the loan, which is going to be 90 days. And we're going to compare that to the days in a year, which we're going to assume nice even 12 months times 30 days in a month, or 360 days. Home tab, Font Group, underline. That'll give us the percent of a year. In the outer column, that being equal to the 90 divided by the 360. I'm going to percentify that number. Home tab, numbers, percentify. We'll add a few decimals on it. So about 25% of the year, of course. And then I'm going to format these. I'm going to select these three. Home tab, alignment, indent. And then we'll indent this one again. Home tab, alignment, indent. So then we're going to put this as a subtotal in the outer column. And so I'm going to say this is going to be equal to the P times T. Add a few decimals just to see it more exact if we need to. And it's nice. Okay. And that's going to give us our interest rate, which is going to be equal to the 290 interest divided numerator divided by the denominator. And if I was to add, percentify that, home tab, numbers group, percentify, add a few decimals, we get the 7.48. Now, again, if we wanted to prove that calculation, I can then plug back into our formula here. P times R times T should give us the interest. So that's going to be equal to P times the rate we just calculated times T, which is the percent of the year, or 25% of the year. That gives us our 290, kind of verifying. That would be our normal kind of condition here. Now we're going to say, well, what if they discounted this thing? Well, that means that they're not going to give us the 15,500. They're going to give us the 15,500 minus the 290 up front. And so we're going to have to modify our calculation. So we'll do that first using this calculation and see the difference, what the effect would be. So we're going to say, all right, then the interest is still going to be the 290, but they took it out up front. So then we're going to divide that by the principal minus the interest. principal less the interest. So that's going to be equal to the 15,500 minus the 290. That's what we actually get. That's going to be the differentiating factor here, the differential factor in our calculation, because we didn't get 15,500, even though they might call that like the principal, because it's discounted. We only got 15,210. So if I want to compare that to like normal loans, I have to consider that. So then the subtotal in the outer column is going to be equal to the 290 divided by the 15,210. Let's put an underline here, home tab font group and underline. Let's add some decimals there. Home tab numbers, adding a few decimals, and there we have it. So I'm going to indent the subtotal, home tab alignment indent, and then we'll do the other half, which is going to be the inverse of time calculation, days in a year. So I'm going to say days in year, which is going to be equal to 12 times 30, 360, and then the days loan outstanding is going to be the days of 90 days. And then we're going to have the subtotal. I'll say subtotal, subtotal, and that's going to be on the outside, this being the 360 over 90. And I can then add some decimals there. I don't think we need to, but I'll home tab numbers, add some decimals. And then I'm going to indent, home tab alignment indent, and that's going to give us our effective interest rate on the discounted loan. Effective interest rate on the discounted loan being equal to this numerator, or this times, not a numerator, but this times this. All right, I'm gonna underline home tab font group and underline. We'll percentify this, home tab numbers, percentify, add a few decimals. Let's just add 2. We could double check this once again by looking at our interest calculation to calculate the interest, which we should get to the 290, which would be equal to the principal, now being the principal we got, not the 15,500, but the 15,500 minus the interest we paid up front, which is what we actually got to use. And then we're going to say that times the rate, which is the 7.63 about, and then times time. The time, now we have to calculate this because this is the inverse. So the time is going to be equal to, I'll put brackets just so we can see it a little clearer, more clearly, is going to be the 90 divided by the 360, fraction of a year. And that'll be 290. So we can kind of verify that there's our 290 of the interest if we think of it in kind of like normal loan terms. Obviously, the interest rate that we have here differs from the interest rate that we would have under this kind of scenario over to the right, where we would actually get the 15,500 and have to pay 290 on top of the 15,500 after the term of the loan has ended after the 90 days. Let's do this calculation one more time, and we'll just do it using this calculation. So same thing we did up top. We'll get to the same number. We'll just use this calculation, breaking it out in this kind of format that we did over here. So we'll say, okay, interest, I'm going to put that all the way to the right. That's going to be equal to the 290. And then I'm going to pull this into the inside. So the P times T. So that's going to be the principal minus the interest. This is the key factor once again. That's going to be this minus this. That's how much money we got. I'm going to make that yellow because that's the key factor we're considering here. That will give us then we have to multiply that times time, which we're going to need the fraction of a year to do. So I'm going to say, all right, the percent of a year, and that's going to be the days of the loan. The days of the loan, I'm going to put this on the inside now, which is equal to 90 days. And then compare that to the days in a year, which we're going to round once again, 30 days times 12 for that 360. Underline this. Notice this is the inverse. These two are inverses of each other here. And that's going to be then the percent of a year. Putting this in the middle column. So now we'll have P and T lined up in this middle column, this being 90 divided by 360. Let's add some decimals to it. Home tab numbers, adding a few decimals. So there we have that. We're at that 25 again, or let's percentify it and then add a couple decimals. So that's percent of a year. I'm going to highlight these three. Home tab numbers. Let's indent here. Let's indent here. Home tab number indent. This will be then our subtotal total. I'm going to put in the outer column, which is going to be P times T. P times T is going to be equal to P times T. Going to underline this, home tab, font group, and underline. And then the bottom line number will once again be the effective rate on the discounted loan, which is going to be equal to the 290 divided by the 3803, which I'll add some decimals to. Home tab number, add a couple decimals. We'll make this a percent. Home tab number, percentifying, add a few decimals. Once again, we're at that 763. Once again, we could double check that number by, I'll do the calculation down here. We could double check that number by, let's do it down here, by saying we want the interest being principal times rate times time. So the principal, that's being the key factor, is really this number, not the 15,500, times the rate, which we calculated here, times the time, which is 90 over 360, or 25% of the year. That'll give us our 290. That'll give us our interest calculation up top. So notice this will be helpful if we're trying to compare a discounted loan to a normal loan. We could say, well, let me compare this rate to like a normal loan rate and see what, and so we can compare the same thing to the same thing, or apples to apples, as they say.